Hi, I'm Peter Rose, founder of Longwood Currency Trading. I did a video a little while ago about the dangers of can you afford to lose 50% of your account, and talked about the fact that if you lose 50% of your account, you have to make 100% on your remaining balance just to get even. And I had an interesting comment that I'd like to share with you. One of the only comments I got, emails on it. But the person said, well, you'd be pretty stupid to lose 50% of your account. Well, no, you wouldn't, particularly in Forex. It's a complex market. It's a fast-moving market. And our worst enemy is hope, fear, and greed, okay? We're greedy at the wrong time. We're hopeful at the wrong time. Sometimes you get greedy at the right time and it all works out for you. But if you don't really understand the interplay between those things, a position could go against you and you'll go, oh, it'll come back because of whatever, economic conditions, squiggly lines on the chart, it's Tuesday, whatever. And it doesn't come back. And you get a quick jump and it takes your position 10% out because you didn't put your stop there. If you're day trading, sometimes if you're adding lots in and moving stuff around, you don't put a stop on there. I mean, when you're beginning, you don't do that, but sometimes you don't put the stops there. And you can get a 20 or 30 pip rush move. NFP goes off and it could be 60 pips in 30 seconds. I've been involved in those. I've seen them. And even if you are setting a stop, are you setting it on the right side? You're sitting at an NFP. Oh, that looks pretty good. I'm going to get in. It reverses, and you're sitting there, and all of a sudden you're 50 pips underwater. If you're carrying a big load at that time, that's tough. You probably have your finger on the button, and you're going to get out of that. But if you're carrying lighter loads, like you get 2 or 3 lots on it, $30 a pip. It goes 50 pips against you, and you go, well, that's just the NFP, and it'll come back. And it comes back a little bit, and you say, well, okay, that's all right. And then back down another 20 pips it goes, and you're sitting there not able to put that stop into place because of your fear and also your greed. I mean, it's a mix at that point, right? You're afraid it's going to go lower, but your greed says it'll come back, and you thought you had the right side of the trade, and you got all this shit going on in your head, but price is moving rapidly against you. Probably not in one trade that you'll take a 50% hit, but with that kind of attitude, you sit there and go, man, eventually this will turn around and come back. It'll go off, it'll bump off the 55 period, and I'll be all set. And it'll take me a couple of days to get back, but that's okay. Well, then it goes past the 55 on your 15-minute chart, and you come to the realization that that doesn't really mean anything anyway. So you go up to the 4-hour, which is a little bit more reliable of what the institutional traders are doing, and you've got another 40 pips till you hit the 55 period there, and you're already way underwater right now. So if you get out, you take this massive loss, but if you stay in and it bounces off to 55 and it comes back here, then you'll load more lots on, and you'll reverse stage, and you'll be okay. And then it blows past that, and then you just get pissed off and you hold it, and that's how you go 50% down. That's how you lose your account. I know all about that. I've had that happen to me. So it is not as strange an event as you would think among the Forex currency trading population to have your account go to 50%. And I've talked to some people who have had large accounts and have had 50% pulls. I've lost 50% of a large account. I understand this. So, yeah, I've lost more than that. But when you are involved in it, I mean, if you're sitting back, sipping your coffee, speaking of that, sipping your coffee, you can be an armchair hero and say, well, you should have got out because, you lost $5,000 and that should be enough. They should have a panic stop there. You shoulda, 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 shoulda. Yeah, but when you're in the heat of the battle and you've gone into that position with your entry analysis, even though it's wrong, you don't know it's wrong or you wouldn't enter the trade, but something malfunctioned in you. Maybe you didn't know there was an NFP release. Maybe you didn't know that there was going to be an earthquake or whatever it is that triggers these things. When you're in that position, live, runtime, real time, you are locked in to your belief that you were correct in your analysis, and that will kill your account. I don't know how many times that's happened to me, and I've lost significant amounts of money, and I ask myself, why is this happening? I know better than that. Why don't I set this stop? In my case, the reasoning is I go off and on between having to stop and not having to stop because I'm trading a large lot size, multiple lot size positions, and I'm always going in and coming out and doing that. I'm getting a little screwed up right now because the U.S. has FIFO rules about pulling lots off, and so you pull some original lots off, and all of a sudden you find your position underwater, even though under the average conditions of the other one you were way in the money. Now you're underwater and you go, well, I should be okay, and then you're not okay, and it becomes very frustrating because you didn't put that initial stop there when you should have, and the excuse is, well, I'm day trading or I'm scalping it, we don't put stops in there. Well, if you're going to be day trading and building your trades and adding positions, you could at least put a panic stop on there. The problem is with the panic stop is if you're adding and subtracting lots and stuff in real time, what value do you put on that stop for lots? And I've done that, and I've got caught with a big alternate position because of that. There are a lot of reasons, and they're not excuses. Losing 50% of your account is not way out on the standard deviation chart. It's not way out on the tail. It's something that is very real and very probable that could happen. And I wasn't as dramatic as I perhaps should have been in that other video to say, you should really be aware of the danger of this thing, because I identified it as something that you should look for, but it's an account killer. 50% of your account, and now you got to make 100% to come back even. If you're trading and you have money outside of that and you lose 50% of the account, you can always go to the bank and put more money in. If you're trading too many accounts and you lose, and you have a $2,000 bank, let's say, too many accounts, and you lose $1,000, you can go to the bank and put another $1,000 in. It's not a big deal. If you're trading $20 a pip, you're two full lots, and you lose 10 grand, you can always go to the bank and put that 10 grand in to bring the account back up to 100%, and then say, okay, I'm going to start over here, and I'm going to do this the right way. The problem is if you don't address the root issue, it may happen again. And at some point, you're going to go, oh, well, I'm only 50% down. I've come back from that before, so I'll just sit here, because ultimately the price does come around and come back because of blah, 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 blah. And then you lose your account. Once you start to roll down the hill, it's really hard to stop. So just be aware of that. And the dangers of it could take you out of the forex currency trading game, totally. And you're sitting on the sidelines saying, I was trading a 3-lot position, and I'm down to the point where I'm trading mini lots. Well, what's the point? So be very, very careful, because it's very crushing to your ego, and it could be a planet killer in that it just takes you out of the game completely. And that would be unfortunate because of the opportunities that are there in Forex. It's like driving a car and you get into a really bad accident. Do you drive the car again, or do you run in fear of ever driving again? Some people are afflicted with that, but for the most part, there are reasons why you didn't pay attention or whatever. You're gonna you get back in the car, In currency trading, it's not quite so easy to get back on the horse, as they say. So be very careful that the event doesn't occur at all so that you're not faced with that decision. But every time you push bid ask, you better be highly aware and sensitive to the fact that if you get in at the wrong time and something happens and you don't have a stop there, you could be 50 to 100 pips out before you can even realize that your shit's gone. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.